The moving average convergence divergence technical indicator is one of the most popular technical indicators on the planet. Also known as the MACD, this popular little indicator is often used in the foreign exchange, cryptocurrency, and stock market trading, or any kind of security really, to help indicate the momentum of a particular security's price movements. You're watching one of 4 episodes I've built on this subject, these being what the MACD actually is, how to integrate it into your auto trading bot, and then 2 of the most popular strategies that this little indicator has given birth to, the MACD crossover strategy and the MACD zero cross strategy. I hope you enjoy. Let's talk about the moving average convergence divergence technical indicator. Now, probably the most important thing that you need to know is that the MACD, as you might think it's called, is actually called the MACD. Now, so if you're talking to another technical trader, that's what they're going to talk about it as, the MACD. All right. Now, turns out the MACD is made up of 3 different pieces of information. The MACD line, MACD line, the MACD signal line, and the MACD histogram. But in order to understand how these pieces of technical information are used, we need to start by talking about how the MACD is actually generated. Here's how it works. So the MACD takes as an input 2 different pieces of information known as exponential moving averages. These exponential moving averages are typically the 12 and the 26, and as you can imagine, they have different values at different times. As stocks move, these exponential moving averages tend to move at different speeds based on their size. The MACD line then is actually the difference between the fast or smaller EMA and the slow or bigger EMA. That's the first thing to realize. So the MACD line is the difference between the 2 exponential moving averages. The next thing we have is the MACD signal line. And this is actually an exponential moving average of the MACD line. Makes sense? So the MACD signal line is the exponential moving average of the MACD line, which is itself the difference between 2 other exponential moving averages. Whew, I'm exhausted even saying it, and as you can probably see, I'm getting my words twisted up just trying to get there. But that's kind of like the key point there, right? MACD line, MACD signal line. The MACD histogram then is a visual representation of the difference between the MACD line and the MACD signal line. So I have 3 pieces of information. The MACD line, which is made up of the difference between 2 exponential moving averages. The MACD signal line, which is an exponential moving average of the MACD line. And then we have the MACD histogram, which is a representation of the difference between the MACD line and the MACD signal line. That all makes sense so far? Now, if you're someone who likes to see this in a visual format, as in read it, I've put a link to my Medium blog on this exact topic, just so you can read through it afterwards to make sense. All right, so hopefully that makes sense so far. Let's continue. The previous section was a lot of words, so I thought I'd make a video to explain it. Here, I've plotted the USD JPY currency pair with the MACD indicator and the 3 components, the MACD line, MACD signal, and the MACD histogram. So let's go through it a little bit. I'll start by turning them all off and just kind of walking you through what is pretty obvious on the chart. We've got the USD JPY doing its thing, as you can see, just after COVID's huge sort of jump right up to 150. Then we have the MACD line or the MACD line. And here, which is the difference between 2 EMAs, in this case, the 12 and the 26, you can kind of see how it roughly follows what's going on with the USD JPY until you start getting these big price movements. If you have a look at the axes on the right, that's the MACD. All right, with the MACD signal then, which is an EMA of the MACD line, you can also kind of see how it follows, but it's lagging a little bit. And every now and again, you see it cross the actual MACD line. And finally, we have the histogram there, really faint in the purple. I'll zoom in. That shows you kind of the difference between the lines, or the size and the difference between the 2 lines. And that's kind of like a really strong indication of when the price is moving strongly. All right, so all we have that all oscillating around zero, and then we kind of have the candlesticks going along doing their own thing there. So from there, we start to get some really interesting pieces of information. For instance, when the MACD line and the MACD signal line cross each other, we often see a movement in one direction or the other. All right. If we have a look then getting a little bit closer into those crosses, we can kind of see that typically when it crosses above, we start to see a movement of the price rising. Interestingly, and in the theory of the MACD kind of technical indicator, the size of the histogram often indicates the strength of the signal. So the bigger the relative size of the histogram, the more likely a given signal is to be, accurate. We also start to see some interesting information when it comes to the crossing of the zero line, like I just zoomed in to show you. For instance, we often see that when the MACD line crosses the zero line upwards, we start to see a price movement up. When it crosses the line downwards, we often see a price movement down. Hopefully that makes sense. And once again, the histogram indicating the size. The three pieces of information that the MACD indicator provides has given rise to two really popular strategies that a lot of people use when they're doing their trading. Now, I'll just quickly let you know that the next 3 episodes on my channel after this one will actually tell you how to build the technical indicator for yourself. Then I'll go through both of the strategies that I'm about to outline. So hopefully that helps you build them into your auto trading bot. So the first strategy is what's known as the MACD crossover strategy. And this one simply looks at the MACD line and the MACD signal line and looks for when they cross each other. When the MACD line crosses below the MACD signal line, that is interpreted as a sell signal. And when the MACD line crosses above the MACD signal line, that's interpreted as a buy signal. And the strategy is kind of built around that. When I show you how to do this in my channel, I'll put some arbitrary take profit and stop loss values. But ultimately, the idea is that those two lines, when they cross, will represent a buy or a sell signal. More advanced traders then will use the histogram that is a part of the MACD in order to give themselves a strength of that signal. For instance, if you have a MACD crossover and the histogram is small, that indicates it's been a weak signal. If you have a MACD crossover and the histogram is large, that will be interpreted as a strong signal. Hopefully that makes sense. The second strategy looks at the MACD line and the zero line and looks for when they cross each other. As you can probably imagine, it's creatively called the MACD zero cross strategy. Once again, when the MACD line crosses below the zero line, that's interpreted as a sell signal. And when the MACD line crosses above the zero line, that's interpreted as a buy signal. Also, more advanced traders will often use the histogram in exactly the same way as before. They'll basically use it to indicate the strength of that zero cross. Hopefully that makes sense. In the code that I show in the next few episodes, I don't put in the histogram, but I will show you how to do the signal line cross and the zero line cross. If you're planning on using the MACD in your trading, there's a few weaknesses that you need to know about. The first thing to realize is that the MACD is a lagging indicator, and that means that there are going to be times where it kind of lags behind the price movements. That's really important because the MACD's strength is really in those big price movements, so any lag could potentially cost you profit. The second thing to realize is that the MACD is typically not that strong when it comes to sideways markets. It's just because of the way that it works and its use of the exponential moving averages and comparative values, it kind of means that when the market is really not going anywhere and you just kind of see it trading in those really tight ranges without any large movements, the MACD is really not that effective. So really, I'd really recommend that you consider using a different technical indicator during those times. Hopefully that's all made sense, and hopefully you've enjoyed the episode. Let me know if there is a technical indicator that you'd like me to cover. See you soon.